Huge week of earnings. We had several big names report last night, including Meta, Microsoft, Alphabet. And tonight we're going to have Amazon and Apple, Coinbase, Reddit, and more. I always tell you to have some cash. Even if the market wants to go to all-time highs, earnings season will bring opportunities. And last night, we got a few of those opportunities. Today, I'm going to share 5 stocks that I think are attractive buys right here and right now. Some of you might have been wondering why Meta Platforms was down something like 13 or 14% this morning. You can see the low today was $650, trading right now at $673. So it has risen a little bit since the lows, but we're still down over 10%. And that's because of a miss last night on earnings. And you do have a knee-jerk reaction. I'm going to cover the reasons why the stock sold off, but primarily it's this right here. And I think some misunderstanding of exactly what this means. It deals with a one-time tax charge I'll talk about. But this Q3 GAAP EPS $1.05 missed in a big way by $5.66. This is short-term. I'll explain. Revenue very solid, $51.24 billion, up 26.2% year over year, and almost a $2 billion beat. Overall, the activity has been pretty strong, increase of 8% year over year. Ad impressions up 14% year over year. Now, in addition, they did give some guidance here. Expectation 56 to 59. But of course, this 57 is higher than the lowest number they gave us of 56. Now, expenses as a percentage of revenue. This is where we start to see some issues. It's also important to note that the earnings per share adjusted was actually $7.25 and beat the estimate of $6.69. But Meta said the implementation of President Trump's One Big Beautiful Bill resulted in this one-time non-cash income tax charge. And Meta expects that this law will result in a significant reduction in its U.S. federal tax cash payments the rest of 2025 as well as future years. So net, this is going to be a positive, but Wall Street doesn't usually care about next year. It cares about today. So why is Meta stock down? And is it a buy? And for what reasons? We need a thesis here. So missed on reported earnings per share. We just talked about it, mostly because of this large one-time tax charge, which is temporary. Expenses rose this quarter faster than revenue. This also deals with CapEx spend. Concerns over rising expenses and AI spending. In addition to that, on the earnings call, Meta told us that CapEx spend for AI would increase in 2026. And more money being spent on AI CapEx, of course, is going to be good for names you probably already own. The NVIDIAs, the AMDs, the Broadcoms, Arista Networks, A-Labs, and more. Now, you might recall a few years ago when Meta got into, well, it was Facebook, and they changed their name to Meta for Metaverse and started spending a bunch of money on Metaverse servers and so on, CapEx. The stock was hit really hard, and if you bought it when it was beaten down, it was a great opportunity and you made a lot of money. Now, unfortunately, this sell-off isn't quite as aggressive as that last one, but we are in an expensive market, and this is looking attractive. I'm going to share why. Another thing to consider on the kind of negative side, ongoing losses in Reality Labs. They had a $4.4 billion operating loss and just $470 million of revenue. Now, some of the positives, the core business, this is a digital advertising company. It does have strong growth. Advertising-driven revenue grew 26%. That's the fastest pace since Q1 2024. And this is being fueled by those robust ad impressions and expanding AI integrations. I think these numbers will continue to do well. This is a big tax charge, a one-time hit, but it's a positive in the future. Now, for those accounting nerds out there that want more information, of course, I post things like this in Discord that breaks down exactly what this is. Most of you don't care about the details, but you can pause the screen and read. And overall, the sentiment from analysts is positive. I think it's a knee-jerk reaction, just a misunderstanding by Wall Street exactly what this is. Of course, the market just hit all-time highs as well. And so any little thing like this is going to make the market gyrate. People are going to sell, especially when they see those big numbers and they don't understand what they mean, those big losses. But this is a much more attractive valuation, of course, today than it was yesterday, post-dip. So let's look a little bit closer. Now, what's really interesting about Meta Platforms is the gross profit margins are higher than a lot of SaaS companies. A lot of times you'll see 75%. Some SaaS companies are 80 to 90%, but this is pretty good. Digital advertising, it's a tricky space, but they do very well at it. And the gross profit margins are pushing 82%. So you'll see a profitability grade of A+ here on Seeking Alpha. They're bringing in almost $1 million net income per employee. So very healthy when you think of profitability. Now, growth-wise, we saw an acceleration, 26%. You're seeing 19% in these numbers, but overall, very solid. We'll give it a B-, maybe a B after last night's report. Valuation, it's going to give you an F, but I think that's a little bit misleading, and certainly never buy or sell just off of these metrics. It's one tool in the tool belt. I look at PE gap forward of 26. Yes, that is expensive. This is comparing it to other communication services companies. And again, this is digital advertising. So it's tricky because it's not comparing it to like software companies. It's not a SaaS company or something like that, right? So it's not going to have the same premium. It doesn't have true recurring revenue. It's going to have to go to bat and get new ads every single week, every single month. But this is attractive, especially when you start looking at, for example, the PEG ratio. It could be even better, but 1.72 is not terrible. The TTM's a 0.66. Price to sales, just out of curiosity, that does look a little expensive at 9.58. But overall, this is very solid. It does pay a dividend as well. Just started paying it. It's a small dividend, so it's an up-and-coming DJIF stock. In the last year, it's only up 14%, where a lot of names have actually, just crushed it. Year to date, up about 15%. Over the past 5 years, 157%. And that's compared to 110% on the S&P 500, so beating it by 40% over 5 years. Now, looking at a chart, you can see the R3 up here at about $818. It broke past this S3, and you can see it got all the way down this morning to under $650 a share. That was an opportunity, I think, to add. It's bounced a little bit off of that. It's 676 right now. It's around the 200-day moving average. Now, if you look at April, it got down to 479. It's not going to probably get down to April because we don't have a huge macro event. If we have a huge macro event, could it come down to those levels again? Possibly. So when you look at this, here's your high end. This is your reward. Your risk probably isn't this low, and it's probably somewhere in the range here. So it got kind of in the top end of that range, right? So when I look at this, my risk is probably, something like another $50, maybe $100 lower. Certainly can go lower, but just off of this event and the upside, and if we keep going in a bull market, you could see $800 in the R3, even $900, maybe even $1,000, possibly even next year. It depends on what the market does overall. So it's an expensive market, and it might not be your favorite stock. You have to buy based on your blueprint and your conviction. But this stock is definitely one that you should consider to buy when everything else is pretty expensive. When we're investing in stocks, we like to look at secular growth trends to invest in, to capture those mega trends and ride those waves. AI, of course, being one of those big ones that we caught early. Another trend that we've been talking about for years is cybersecurity. And high quality names that I consider more of a core cybersecurity name, like a CrowdStrike, I've been covering on this channel since 2019. I also like names like Palo Alto and others for smaller positions. One of the more recent IPOs that's kind of a fringe play within cybersecurity that we've been buying in the community is called Rubrik. Now you can see comprehensive cyber resilience across data and identity. I'm going to break this company down in very simple terms so you understand exactly what it does. The main areas of focus here for Rubrik is going to be backup and recovery, ransomware protection, disaster recovery, data security, cloud data management, as well as analytics and compliance. And some of you are thinking to yourself, great, but what does that mean exactly and why should I buy this stock? So imagine that you're running a hospital or a bank or even a huge online store. What's your most valuable asset? Not the building, not the products, the data, the patient records, the customer payments, the sensitive data, the inventory lists. Everything lives in the cloud, on the servers, and in apps like Microsoft 365. Now imagine a hacker locks all that up with ransomware. They demand millions of dollars from you or it's gone forever. And that's not science fiction. That's happening to companies every single day. And this is where Rubrik comes in. It's not just another backup company. Think of Rubrik as a cybersecurity SWAT team. So they're gonna back up your data, but smarter. Most companies back up data once a day, but Rubrik is gonna do it continuously, quietly, and in the background. Hackers can't delete or encrypt the backups, even if they get inside your system. And it works everywhere. Your Office servers, AWS, Azure, Google Cloud Platform, even inside apps like Salesforce, Slack, and more. Rubrik uses AI to spot attacks before they spread. It watches your data 24/7. It notices weird behavior like, wait, why is someone encrypting 10,000 files at 2 a.m.? That seems a little suspicious. It also flags things like ransomware before the damage is done. And Rubrik will get you back online fast. Most companies take days or weeks to recover from a cyber attack. But with this, you can restore entire systems in minutes, like hitting undo on a disaster. It's like if you're using Microsoft Office, you make a typo and you hit undo, boom, that's kind of what it's like. They call this cyber resilience, not just surviving an attack, but bouncing back not only quickly, but instantly. And Rubrik is built for the AI future. Companies are now using AI models trained on sensitive data. They're also using AI agents, and Rubrik will help kind of keep those in check. They launched Rubrik Agent Cloud. That's the first platform to secure AI agents and their data pipelines. They even acquired a company to help businesses run private AI safely. What are some of the highlights? It's down over 5% this week on no bad news, really just market noise. Some of those cloud names just gyrating. Some of that's from GTC events as well. Certain names like CrowdStrike spiked because Jensen talked about them, others not so much. But for the most part, it's just market noise. Nothing fundamental has happened. Earnings have been crushing it the last several earnings reports. 96% recurring revenue, software as a service. Solid 36% annual recurring revenue growth, $57 million free cash positive, which isn't a big number and it's not GAAP profitable, but it's working that way quickly. The large customers with $100,000 of revenue or more is up 27% in this recent quarter. They also partnered recently with Cognizant to launch business resilience as a service. Think cyber insurance and instant recovery in one subscription. And Gartner named these guys in the Magic Quadrant #1 in vision for backup and recovery 6 years in a row. And this is a newer IPO. The analyst price target average is $110, which is something like a 50% upside from here. Of course, let's talk about the risks. I want to give you the bear case. It's still losing money on paper, not GAAP profitable, but again, heading in that positive direction quickly. It does have competition. There are other names out there that do this. Now, some people will say, well, why doesn't CrowdStrike just do the same thing? CrowdStrike partners with Rubrik, and it's not really their core competency. These other companies like Veeam, Cohesity, Commvault, they do something very similar. Rubrik is the best of breed. It's also a high growth stock, high risk reward, high valuation, high beta. It's a SaaS name. I tell a lot of you guys you shouldn't even own them. If you do, you buy them as spec. If growth slows down, of course, the stock's going to dip. If we have any sort of correction, names like this get hit worse than other names. Final thoughts, bold thesis, and I'll show you a chart. Rubrik isn't selling antivirus. They're selling peace of mind in a world where data is lifeblood. The stock dipped on nothing real, just really sympathy selling in tech. 40% growth, AI tailwinds, and a path to profitability. It's a newer IPO. The chart says it can go lower, and I'm going to show you. But if you believe companies will keep getting hacked, and they will, then Rubrik is a pick and shovel play in the cyber gold rush. Again, more of a fringe play, but I like this company as a DCA below $75. Now you can see, again, new listing just last year around March, so it's not very old. Thing ripped from 28 bucks up to $103, pulled back. This is where we want to buy these pullbacks after the air pockets kind of come out of these stocks and fallen down. Can it go lower? Yeah. In fact, we have an S2 here that's going to be 68 bucks. You have an S3 here that's going to be $57. It got down to 70 this morning. I think 75 or less DCA. So if you're using that technical analysis lot allocation strategy we teach in the masterclass, you're buying here, you're going to buy on the way down. You got to do what's best for you. But I like this stock as a long-term investment, $75 or less DCA. This next stock should get your attention for more than one reason, not only because the stock is absolutely tanking today, but also some of the things that were said on the earnings call last night. Now, here's the headline, and the headline is telling you that basically people can't afford to eat the food, their target audience, right? So this is the challenge cohort, this is in quotes, particularly challenge cohort is a 25 to 35-year-old age group. Now, if you're in that age group, drop me a comment. Let me know. Are you in this boat here? This group is facing several headwinds, including unemployment, increased due loan repayment, and slower real wage growth. In August, the unemployment rate for Americans aged 20 to 24 was at 9.2%, up from 7.9% a year ago. And a lot of this is from AI pressures and other reasons as well. You know, there actually are some cracks in the economy. Part of the reason why the Fed has to lower rates, so we could go into a 20-minute deep dive on that, but we don't have time for that right now. But Boatwright said the pullback in all income cohorts seen earlier this year has now widened, with low to middle income guests further reducing frequency. Households that make $100,000 or less make up about 40% of the sales. So less money to spend, things are more expensive, less job wage increases. You start to have problems with consumer discretionary, with spending. Of course, that's also 70% of our gross domestic product, so something to keep in mind. And you can see, guys, the stock is being absolutely gutted, down 17%. And if I look at the one-year performance, it's down over 40% in the last year. almost 45% year to date. That total revenue increased by about 7.5% to 3 billion. Comparable sales 0.3%. So you want to see that a little bit higher. Operating margin 15.9%. This is why it's so hard with restaurants, guys. It's why I don't invest in a lot of restaurant stocks. Plus, I'm part owner of an actual restaurant, so I try to avoid the stocks. But that was a miss by 20 million. That 7.5% growth, a $3 billion revenue, and non-GAAP EPS of 29 cents was in line. And one of the positives here is Chipotle is saying that they're going to expand internationally with 350 to 370 new restaurants in 2026. If I were to, I'm not a gambling man, but if I were to make a wager, I would say that number's probably going to come down if the macro starts to deteriorate. Another positive here, and this is from our Discord, Zach brought it to our attention this morning. So 2 growth drivers, we just talked about that international expansion and just overall expansion, as well as automation. So you're going to see maybe less workers, more automation, robotics being used within restaurant industry, particularly with Chipotle. And he's saying once the economy stabilizes again, could take years with the job cuts, I think they'll be in a good place to normalize growth again. Now, if you actually think it's going to take a long time for the economy to stabilize, this stock probably won't perform well in that time. On the flip side of that, in theory, interest rates coming down should help the consumer. Profitability wise, 40% gross profit margin. That's actually not terrible for a restaurant, but you can see net income per employee only 11,800 versus Meta pulling in about $1 million. Tech companies are where the money is made as investors. That's where most of my money's at. But we're looking for opportunities here in a tough market. And this is definitely something to at least dive into and to consider. This growth rate, we saw the growth rate before, but we're projecting here on Seeking Alpha about 10%, 11%. Valuation wise, it's still not cheap for the growth, 33.98 forward gap PE ratio. That PEG is also a little bit high if you look at that. And we want that closer to 1. It's 2.13. It could be worse. Price of sales, 4.42. It doesn't pay a dividend. I honestly think that it should pay a dividend. Would give a reason for more investors to own it, kind of an up-and-coming DJF. The problem, though, is that it's just tough in restaurants. There's not a lot of extra money left over to be paying things like dividends. And before somebody says it in the comments, I would rather have the company in this stage, if it can grow 300, 400, 500 restaurants and grow internationally, I'd much rather have Chipotle spend that money on growth versus paying a small dividend. If you're in our private community every single Wednesday, on chart day, I talk about air pockets all the time. This stock back in 2022 summer, was $23 a share. And it ripped from $23 a share to almost $70 a share. And this is what we talk about all the time. Don't buy air pockets. Those air pockets often get they get popped, and here we are. So now we're below that trend line. Air pocket is popped. In fact, we're all the way down here. So the daily low on the stock was $31.01. Now trading closer to $33. You can see this S3 is at $35.96. And we're well below that. So a bit of a broken chart in terms of technicals when we look at this. I don't see it going back to 2022 prices. So when I'm looking for opportunities in a tough market, this is getting pretty attractive at $32 considering, June and July of 2022, over 2 years ago, it was trading around $24, $25. If this stock gets to $30 or less, to me, that's a real opportunity to buy. But if you really like the company, though, and you've done your research, I think it's a buy right here, right now. And as a reminder, always use dollar cost averaging and make your own decisions. I'm not your financial advisor. Let's stick with the restaurant theme for one more minute. Now, I've never been to a CAVA. I don't own the stock. I'm not buying it. Several members in our community are bullish on this. You can see it's down about 10% today, trading under $55 a share. This is a newer IPO. The profitability, similar, a little bit less than Chipotle, actually a little bit stronger down here on the net income per employee. That growth is much stronger, though. 25%, 28%. This is still very much in growth stage. If you look at the life cycle of a business, Chipotle is a more mature company. It's been around longer. That's why I say you're getting closer to where you start seeing a small dividend being a DGIF. CAVA, fairly newer IPO. Valuation wise, very expensive. There's growth. And so people are paying a premium for growth in this market. PE gap forward, 109.17. Price of sales, 5.95. I think this is still expensive. I want to bring it to your attention, though, because I'm seeing several members in our community buy it. And again, we're looking for opportunities in a tough market. And you can see some of my previous comments from chart day. It's always in orange. If you see yellow, it's today's chart day. This is $172. You can see this thing ripped. $37, new IPO. This was back a couple years ago, 2023, June, it looks like. It did dip down below 30 and then rip from 30 bucks, 29 bucks to 172. And I said, FOMO chasers unite. FOMO chasers club, air pocket, don't buy. This doesn't even make sense. Too vertical. Now it's come back. And this is why I tell you guys all the time, I like to wait usually a couple years before I start buying an IPO because they often look like this. Charts, not always, but very often look like this when they come back. This is where you can start looking at it. Certainly can go lower. You can see this previous S3 is below $50 here at $48.99. I think if you're buying it, 55 or less DCA, it could go to something like $45, $50 in that range. Worst case scenario, you'd have to go back all the way here. That's probably unlikely without some kind of catastrophic event. So more than likely here, you've got kind of a new floor that's a little bit higher, probably somewhere in that $50 to $55 level. The fifth stock today is going to be Netflix with an A+ profitability grade, 48%. Does bring in another tech company, right? So $745,000 net income per employee. That's not the only reason to buy a stock or anything like that. It's just a fun metric to really show you how much harder it is to be a restaurant versus something like Netflix. You can make a lot of money off technology with fewer people, right? And that's only going to change with AI. This is more of a mature growth company too, but still very solid, around 15%. Valuation wise, also not cheap, but pretty high quality here. If it gets a little bit lower, I think you're in an area where it starts to get pretty interesting. This one, of course, doesn't pay a dividend. If you look at the 1 year chart, it's up about 44%. Year to date, up 23%. So this one's not beaten down as much as some of these other names we've talked about today. And this is a very parabolic chart, but in a healthy way because it's not straight up parabolic. 169 all the way up to 1341. This is insane. And this is an air pocket. It's come back. It's below the 200-day moving average. It's trading around $1,100. I like it better below 1,000. That's going to get you this blue trend. But more than likely, that's not going to happen with some sort of catalyst, like the greater market selling off, a big earnings miss, or something like that. Thanks for watching, guys. If you're new here, make sure you subscribe. Click that bell for notifications. Drop me a like. Drop me a comment. Have a great day. Take care.